Good day, guys. You're welcome to this section. So, we'll be talking about the strategy which we implement. So, the strategy is based on trend. We'll be combining two time frame. For example, we'll be using the daily time frame and the H4 time frame. So, what we are looking for is a trending market. If you have watched other videos, you'll know about trend, which is, for example, a downtrend is a market going in this way, going downward, and we are creating lower lows and lower highs. While an uptrend is the market moving in this way, whereby we are creating higher highs and higher lows. Now we'll be combining two time frame. So this strategy is based on multiple time frame analysis. What we are looking for example, we'll be making use of a higher time frame and a lower time frame. So to make it very easy, our higher time frame, for example, can be daily time frame, and our lower time frame. So for lower time frame, we can make use of H4. So what we are doing is we are combining these two time frame to back up our decision making process. Now on the higher time frame, which is the daily time frame, we are looking for what we call break and retest. Now, break and retest is a point whereby the market breaks. For example, it breaks a support and pushes lower and changes this support to a resistance. So we also have another method which is for the bullish. If the market breaks this point which is a resistance, it goes higher and it comes back to retest it. It changes to a support to push the market higher. So this is just how break and retest works. Now, when the market breaks below this support and is coming back to hit it, we need these candles to be clean. So I will discuss that though in details later. So for example, what we mean is that we need all these candles. For example, let's take here. You can see that as the price is going down, what do we have? We have a bearish candlestick. And when the price is coming up, we have all bullish candlestick. When price is coming up to this point, we have all bullish candlestick without any bearish interruption until the price gets to this point here to start going down. Let me show you another example. You can see here that while price was going down, we had all bearish candlestick. And when price was going up, we had all bullish candlestick. And when price gets to here, you can see how price rejected and start going down. So we are looking for a very clean break and retest, just like this. After that, so that's the first rule. We look for a clean break and retest in a trending market. So the first rule is that we look for a clear break and retest in a trending market. So this is rule one. So we look for this in the higher time frame. So let's include it. So higher time frame. So this is it. Now the next thing you can do is to put a moving average. So for example, let's put a moving average. So you just come here to indicators. So you write moving average, which you can call EMA. So that is exponential moving average, EMA. And you can change it to something like 30. Now, why do we change it to 30? We want to be sure that the momentum is still intact. For example, as the market is going down and not touching this 30 moving average and giving us this clean break and retest, that means there is high momentum of the market going downward. Now we can see here when the market broke below, came back to retest here to push lower. And also we also had it here, all bearish, all bullish, price coming back to this zone, came down, and also here. So in our one-on-one section, then I will explain it more better also. So you can see how price came down clearly, came back to this zone to retest and also came down. So we want price to be forming this clear break and retest while not touching this moving average, which is just 30 EMA. So we can write it. Our second rule, price should not touch the 30 moving average. Very simple. So that's rule 2. Price should not touch the 30 moving average. So we have the third rule, which is the last rule. So it's just 3 rules. So remember, we are using, for example, a higher time frame. We're making use of daily time frame, and our lower time frame is H4. So if we are making use of H4, that means our lower time frame will be H1. So if we are scalping also, we are making use of something like the 30 minutes. Our lower time frame will be the 15 minutes, or you can make use of the 5 minutes. So but you're making use of the 15 minutes and the 30 minutes and the 15 minutes and 5 minutes also work together. So all we have to do is to go down to the smaller time frame, which is the H4, at this point where price break and came back to retest. We'll notice that we'll see patterns. Most likely you'll see things like the M pattern. So we can see here, so this is an M pattern, or we call it a double top. So you can see that price created an M pattern before the market came down. And also here, it was not that clear, but after practicing this strategy, you will see it very clear. So the next rule, let's write it. Price must create a pattern, which can be either M pattern for selling or a head and shoulder. So that's the third rule. Price must create a pattern on the lower time frame. And I believe we have talked about patterns, the different types of chart patterns. So for selling, we need like the head and shoulder and the M pattern. The M pattern is in this way. For example, when price gets to this point here. So let me use a diagram to explain it better. So while the market was going downward like this, we need a pattern. Now this pattern forms at this point here. You can see here, you had something like this. So this is the point here. So we can see previous support changing to resistance. And at this point, we saw a pattern formed before the market collapsed down. So this is an M pattern. And also, when the market is going up, we'll see the opposite structure. So we have the market going in this way. In a smaller time frame, it's likely something like this. So this making use of the M pattern. So you can also find out the head and shoulder. Also, you can make use of the head and shoulder to enter. Sometimes markets will just form the head and shoulder, which will be something like this. We just have a head and shoulder pattern. So this is the head and shoulder, and we said until price breaks the neckline, a pattern is not formed. So you just take your trade once price breaks the neckline. So the neckline, this is the neckline. Also here, this is the neckline. Here, this is the neckline. Then also for a bullish market, the market will form in an inverted head and shoulder. So this is an inverted head and shoulder. So the market will go up. So that's that about the pattern. Also, when you're taking your trade, at least your risk to reward should be up to 1:2. As you're starting, then when you keep going, you can increase your risk to reward. So risk to reward is minimum 1:2. Now 1:2 just simply means you're risking one to get two. For example, if you're risking $100, that means you want to make $200. So this is the simple and purest form about the strategy. We'll discuss more in the future. So on the smaller time frame, you just look for an M pattern for a sell, and also you look for a W pattern for a buy. So let's go to a bullish example. So guys, this is US 100. So let's make use of it as an example. So you can see currently at this point in time, the market was going upward and we had a resistance. Once price breaks a resistance, it changes to a support to push the market higher. But at this point in time, the market came back to our moving average to retest it and also retest the zone. So on the moving average though, this is not the best of setup because I prefer price not touching at all the moving average. That's when you get most of your trade right. So once price is touching it, most likely just leave it. Just for example sake, so what we do is that we go down to the 4 hours. Then on the 4 hours, we look for a pattern. We can see here, what do we have? We have a M pattern for the market to go higher. So, so this is how we make use of the strategy. So we'll discuss more in the future. So guys, you can see this is USD JPY, and at this point in time we had a bullish example. We can see that the market came to this zone. This was a resistance, and once price breaks a resistance, it changes to a support to push the market higher. So at this point in time, you just go down to your smart time frame, which is 4 hours. Now on your 4 hours, all you're looking for is your pattern. Now this is another way to look for your pattern at this point in time. So after trading this strategy for maybe months, you'll be able to see these different patterns. Also, possibly in the future, I'll be showing you different ways to identify it. So one simple way, you can turn it to a, a line chart to see it better. Or if you're in your trading view, you can go down a time frame, one time frame lower, which for example, instead of 4 hours, after seeing it on 4 hours, you can go to 3 hours to confirm it, to check if there's actually a pattern. And we can see that there's something like this, which is a W pattern, for the market to start going upward. So that's the end of this section.